881 pages of the Build Back Better plan. There's some sections in here you need to be aware of. We're going to bring it out that could impact your IRAs, your estate, your crypto, your income tax, all that. And you need to be aware of. This is literally 2 Harry Potter books, guys. And that's about the size of this bill. 881 pages. I don't know how they do it. Do they really read all this? I don't know. We're going to try to bring you the things that we think are important out of these bills, or this bill, and talk about it right now. So let's get into this and take a look at it. So the positive things that I'm seeing in here is they're going to extend this child tax credit. So if you remember this previous bill that they passed, you had $3,600 going to people that if you had children under 6, which is it was a bonus of $1,600 on top of the normal $2,000. So that they're trying to extend. Same thing for people or for kids. If you have kids from age 6 to 17, they're going to keep that extra $1,000 on top of the $2,000, so $3,000 there that they want to keep extended. There's AGI thresholds for this. I mean, adjusted gross income, not taxable income, which is lower than adjusted gross income. Some things that you can take off adjusted gross income are these. So like we have this software that we use with clients that can literally draft out their potential 1040, what it looks like. So your adjusted gross income is typically on line 7. And it's after like IRA deductions or some others here if we look at the schedule. So Schedule 1, you can health savings account deduction, moving expenses, self-employed SEP simple IRA qualified plans. If you make deductions there, self-employed insurance, student loan interest, stuff like that, alimony paid. So those are some things that can reduce your adjusted gross income, get your income down to that AGI, which is line 7. And then after that, you get your standard deduction, like roughly $12,000 for an individual, $25,100 for a joint. Then you get your taxable income, which is line 10. So that's important when we look at these numbers. Some of these are taxable income, some of them are adjusted gross income, and you need to talk to your CPA about this because there's other things that are impacted by those levels too. And if you're on the cusp of some of these income levels, you can make a slight adjustment in an IRA contribution, HSA, and you get these tax credits. That's huge. So keep on top of that. So AGI threshold, 75,000 single, 112,500 head of household, 150,000 joint. Again, that's for the tax credit. These do phase out, at least I haven't seen the new numbers yet, but they have been phasing out. If you make every $1,000 above those thresholds, you lose $50, or basically 5% of any amount you earn over that, you lose to that. Currently, you are still eligible if your income levels are below 200,000 single head of household and 400,000 joint. You're still eligible for the 2,000. That's the 1,600 extra 1,000 is only that portion there that could be phased out under that plan, but you still would be eligible for the 2 if you have children under 17 on that. All right, the other thing is positive. They were talking about if you normally, as a current law, if you passed away and you had a valuation of a estate of $1 million, let's say you only paid $500,000 for a house or stocks, mutual funds, whatever, and it grew to $1 million at your death. Well, under current law, if you passed away, then those assets would actually be stepped up to the current valuation. You pay no tax on all that $500,000 a gain that you would have had. And they were talking about eliminating that, or at least putting a threshold of like $1 million. And right now, they've so far, from what it looks like in the bill, they're going to keep that. That's good. And there's also some farm provisions in there too as far as estate valuations. A 1031 real estate exchanges appear to be fine as well. That's where you have an investment property, you sell it, and you turn around and buy another equivalent investment property, the same value or higher, or maybe multiple properties, but all that dollar amount that you got from your proceeds was equal to all those different purchases of equivalent properties, like kind of properties. Then you pay no tax on that gain. As of right now, unless we see some adjustment here, and I've heard a little bit of a rumbling of that appears to be still in good shape as well. Other changes, capital gains rate tax. So they were talking about taking this to 39.6% if you made over $1 million, but now they've changed it from where it's just the highest tax bracket is 20%, and it's going to 25%, but that's going to be for people that are earning over 400,000 single, 450,000 joint. I've not heard ahead a household number. I assume it's going to be very close to that 400,000. But the major impact of this, if you fall in this category, God bless you, making that much money, is that on September 13th of 2021 is when it would actually go in place. So if you bought something after September 13th of this year and you turn around and sold it, you could be hit at the higher capital gains rate. My understanding, again, double check with what the final bill comes out and your CPA, is that if you bought something before, say for $50,000 and you sold it, so before September 13th and you sold it after September 13th, you'd be grandfathered in on the old law where you don't have to pay a capital gains rate at the highest level of 20. And there's lower brackets besides that too, but that's the highest bracket. Cryptocurrency wash sales. So a lot of you have been starting to probably trade cryptos out there. I hear it all the time. Before, or at least as of right now, you could buy and sell this stuff as much as you want. Didn't have to worry about a wash sale. What that means, if you buy a security 30 days before or after a sale that was at a loss, so if you bought it $100 per coin and you sold it at $50 per coin, that's a loss of $50. It didn't matter when you did it, buy and sell it. But now they're going to change that. We're on like normal stocks, bonds, mutual funds, stuff like that. If you buy or sell a security 30 days before or after the sale at a loss, then it can be washed out and you can't claim the loss. So they want to add that also to cryptocurrency, and you better be paying attention to cryptocurrency, tracking your sales and on some kind of ledger or whatever, because they're starting to come after that stuff. You have to report that. You cannot not report any gains and stuff on crypto. I just talked about that. All right, this is big for you. God bless you that you have an estate over $5 million. Before it was over 11 million, guys, or if you're joint, double those amount, 10 and then 22. And that 11 million is a little bit higher than that, but just approximation. But they want to reduce this in half. So they want to take 11 million per person all the way down to 5. It was supposed to be 6. Now I'm hearing 5. So the important thing of this is if you have an estate in excess of $5 million, that includes life insurance, if it's in your estate, your house, stocks, cars, mutual funds, whatever. If that all totals up in excess of $5 million as an individual, anything above $5 million, you got to pay anywhere from what I'm seeing 42 to 50% estate tax to the federal government. That doesn't even account your state if they have an estate tax. So you could be up to 60% in some states. So and there's things you can do planning wise. We have attorneys that we work with that can help you minimize that estate tax and get that down. So if it's joint, it'd be at 10 million. So if you got an estate in excess of 10 million right now, say you got a $20 million estate, you could be looking at $10 million to $20 million is 10 million. 50% of that potentially going to the federal government, $5 million. That's a lot of money that could impact a lot of lives or charities versus going to the government. So call us. I mean, if you're finding value on all this information, give us a call. And we can help you out. Like, here's a quick contact information. Share this stuff out to you, to YouTube, to Rumble, all that kind of stuff. Share it out. Share it on Facebook if you're finding value, and we can get some help to you or some other people that might find these things being impact. All right, let's continue on. Here is, corporate taxes. So right now there's a 20% corporate tax rate, flat. They're going to change that to a graduated rate structure. So they're going, and it looks like this. So the rate structure provides a rate of 18% on the first $400,000 of income, 21% on income up to $5 million, and a rate of 26.5% on income thereafter. And then the benefit of the graduated rate phases out for corporations making more than $10 million. And personal services corporations are not eligible for the graduated rates. And I don't know if that means that they're just going to get hit at 26% or not. I have not seen that. The other tax that's out there that you have to be aware of, this is on passive income, interest, dividends, capital gains, rental income, and then possible business income over active business income over $500,000. You get hit with a 3.8% investment tax. If you're 200,000 single, $250,000 joint, or like I mentioned, possibly $500,000 for businesses. And that's just not passive income, that's active income. So they're going after that. So now IRAs, this is big. So no mega or regular backdoor Roth IRA in 2022. So normally under current law, it didn't matter your income levels or anything, you can make a contribution to a IRA, non-deductible, so you can't deduct it off your taxes where it makes your taxable income and your adjusted gross income level lower. But you can make an after-tax contribution, take that and roll it directly into your Roth IRA, and then that would grow completely tax-deferred and tax-free when you pull it out way down the road. And then same thing with people have 401ks that have a after-tax component on it. Some don't, some do. But if you did, you could make that contribution to the after-tax 401k, turn around and roll that to a Roth IRA and let that grow tax-deferred and then take it out tax-free way down the road. That's no more. It doesn't matter your income levels, anything. They're taking that away. So if you're looking to do that before year end, you might want to get on top of that. Talk to your advisor, your CPA to double check it. The other thing is no more Roth conversion. So this is completely different. So this is if you made a tax-deductible contribution to a 401k, to an IRA. Let's say you took money from the 401k, rolled it to your IRA, and then you want to convert that to a Roth. So you have to pay tax on that money and then turn around and put it in the Roth and let that grow tax-deferred and tax-free down the road when you pull it out. So they're actually going to nix this starting in 2031 for income levels that are 400,000 single, 425,000 head of household, and 450,000 joint, and that's taxable income. So not adjusted gross income, but taxable. So if you're on these thresholds and there's something you could do to lower your taxable income eventually down the road, that's what you're going to have to pay attention to. So they are getting rid of some of that Roth stuff, but if you're a self-employed individual, filing an S Corp or whatever, Schedule C, you can still do a solo Roth 401k, and you can get in up to like $58,000 in these, which about $26,500 if you're over 50, $19,500 if you're under 50, $19,500, where those can be Roth contributions. So that's kind of a mega Roth account, but it's only available for somebody who has a small business. So if and you got to have income, you got to show profit. So if you're thinking about on the side starting up a business, there's something you really like to do, you could think about doing that and be able to fund more into than a regular Roth IRA. And this is very critical. It doesn't matter your income level, anything. They are coming after self-directed IRAs, Section 13812 and 13834. These are the ones you really need to think about writing to your congressman on. I'll show you the links here in a second. If you, and a lot of people don't know this, you can take your IRA account and you can invest in a real estate property down the street, rental property, Airbnb. You can help your buddy out, start up a venture, a brewery, or whatever it is, a small business, crowdfunding. You have these crowdfunding sites. You can actually do that with your IRA account. But what they're trying to do now is and the way it's written, they want to nix this, and they're going to force distributions out within 2 years with income tax. I can't imagine they're going to make people pay penalties on this if they really force people out of this, because you have some significant dollars in some of these things. And the reason for this is I don't know if you've heard of Peter Thiel. So he way back invested in Facebook, like pre-IPO stuff, and also founder of PayPal, used his Roth IRA to do it. And he's got a $5 billion Roth IRA, and this has irked people off because he's going to be able to, at least prior to this, pull it all out tax-free. My guess is since it's in a Roth IRA, they're just going to make him force distributions, which I'm going to talk about next, out of your IRAs depending on the levels. But that's the reason why they're coming after these things. But there's a lot of these people, the common man, where we're trying to just invest maybe, 50, 60, 10, 20 into smaller amounts. Maybe there's a lot of people under $1 million IRAs. Most people have that. Allow them to help stimulate the economy, the business, help out venture capital, stuff like that. But they want to take it away. I don't like that at all. A lot of people don't like this, so you need to write your congressman about this. All right, solo 401ks. those are still going to be okay. So this is actually one positive. If you're self-employed or if you want to start a business on the side, you want to maybe look to invest in another business, solo 401ks can be self-directed. So all those other things I mentioned before, if you want to buy a rental property, Airbnb, all that kind of stuff can be done in a solo 401k. They have not eliminated that. It's just the IRAs. If you have an IRA that owns an LLC that buys real estate, you may be able to get around by just changing yourself away as the manager and hiring somebody else as the manager to keep it, but we're waiting to see on that. Roth IRA cryptos are not impacted where you're like mining or buying individual cryptocurrencies and Roths. Those are not impacted. Here's the two websites. Take a screenshot of this. I'll link this down into the description as well, where you can find your House and Democratic representatives in the Senate and the House and write them about this. And you want to mention Section 138312 and 138314. Tell them not to do this. Tell them why you'd like to still have the ability to invest in securities outside of the normal realm. Here's the last thing I want to talk about is forced IRA distributions. Now, most of you are not going to be impacted by this. But for those of you, again, God bless you, have over a $10 million IRA. That's the max you're going to be able to do if you have a taxable income over $400,000 single, $450 joint, and your IRAs 401k are in excess of $10 million. Then they're going to force you to take out 50% of that above the $10 million on that if you're making those levels, income levels, and have that amount. And then in addition, to the extent that the combined balanced amount in traditional IRAs, Roth IRAs, and defined contribution plans exceed $20 million, again, God bless you, the excess is required to be distributed from the Roth IRAs and Roth designated accounts and defined contribution plans up to the lesser of the amount needed to bring the total balance in all accounts down to $20 million, or the aggregate balance in the Roth IRA and designated Roth IRA accounts and defined contribution plans once the individual distributes the amount of excess, any excess required under this 100% distribution rule. Then the individual is allowed to determine the accounts from which to distribute to satisfy the 50% distribution rule above. Whew. Wow. But if you're making over that 400 and 450 and you have balances above that, this is where it's only going to apply. And we'll see what the final thing is on the bill, but you're going to want to be aware of that because you're talking about having to take out, let's say you got a $20 million IRA. You're going to be forced to take out some huge distributions. Whether if you're under 59.5 with this, and again, bless you on that, and you have these values, I can't imagine they're going to make you pay penalties on that because normally if you're under 59.5, you take money out of a retirement account, unless there's a big time exception for that, you have to pay 10% penalty plus the income tax, federal and state. So we'll see what happens here. But I think that is it. Everything I wanted to, no, there's more on more taxes. Sorry. 3% surtax on modified adjusted gross income over $2.5 million filing separately, and $5 million jointly. That's section 138204. And then there's also a limitation on deductions of qualified business income for certain high income tax individuals. And I think that's $500,000 in case you're joint, $400,000 for individual returns. So if you got a small business, there's going to be a possibility some extra taxes coming out there too. So you got to be aware of that. That is it. Wow. All right. So greatly appreciate you joining on. I'm going to start rolling my credits here. Again, if there's any questions or if you got any comments, anything, send me an email, send us a confirmation that you want some kind of complimentary financial consult. We can do that. Take a screenshot of this right here. This got all our contact information. Again, share it out, send it to Facebook, wherever you find your social media being helpful, and see if this could help somebody else. But again, thank you tons. Have a great rest of your day.
Too many days in the darkness without a glimpse of the light, running tired and broken and scared, but I swear I'll never give up the fight. I see you